I'm Dawson Schmidt here with the latest stories and developments in this week's Commodity Roundup on Trader PhD. The Environmental Protection Agency finalized record high renewable fuel mandates for the next 2 years on Friday, setting the stage for stronger biofuel demand. Biomass diesel blending requirements were raised to 8.86 billion renewable identification numbers or RINs in 2026 and 8.9 billion in 2027, both the highest levels on record. The EPA says meeting those targets will require biodiesel and renewable diesel production and use to rise more than 60% from 2025 levels. Soybean oil inventories have been building back above seasonal levels in recent months. That has been due to lower biomass diesel production in late 2025 and early 2026. Looking ahead though, the EPA says foreign fuels and feedstocks will receive only half credit under the renewable fuel standard starting in 2028, a move that could support stronger demand for domestic feedstocks like soybean oil. U.S. fertilizer prices continued to climb last week as tensions involving Iran and the U.S. disrupted a key global shipping route. The Green Market's North American Fertilizer Index jumped 5.2% to $971 per ton, with nitrogen products leading the rally. Wholesale Gulf urea and DAP fertilizers jumped about 4% last week, while Tampa ammonia prices surged by $160. On the retail side, USDA data showed that Iowa retail anhydrous ammonia prices jumped about $80 this month to an average of $942 per ton. Urea in Iowa was also sharply higher at $624 per ton. Much of the pressure is tied to shipping disruptions through the Strait of Hormuz. According to Kepler, fertilizer exports through the strait in March were down about 98% from a year ago. Since late February, only a handful of fertilizer vessels have made it through, while dozens more remain loaded and waiting for safe passage. U.S. fertilizer imports in March are still expected to be strong, with much of the product likely shipped before the disruption began. But looking ahead, the biggest concern may be phosphorus, as a large share of U.S. supplies typically come from the Middle East. Until traffic through the Strait of Hormuz resumes more normally, fertilizer prices are likely to remain elevated. U.S. corn exports have benefited from larger supplies following a record harvest in the 2025 and 26 season and weaker global competition. However, recovering supplies in Argentina could begin to dig into the U.S. market share. The U.S. dominated global corn trade in the 2024 and 25 season, with shipments hitting a record 2.9 billion bushels. According to the most recent USDA data, elevated demand continued into the current season, with exports running about 35% ahead of last year. Now, as Argentina's production is expected to rebound significantly this year, the South American country could see higher exports. Argentina's corn exports in March were the highest monthly volume since July of 2022, according to data from Kepler. Volumes could expand further as the country's corn harvest progresses this spring. Initial yields have been favorable, while later planted corn crops have been developing under adequate soil moisture conditions. This week, state-owned trading firm COFCO also said it's loading its first bulk cargo of Argentinian corn to China in 15 years. The shipment comes after China cleared corn imports from Argentina in 2024. COFCO says the cargoes reflect increasing alignment between the two markets and provides an additional sourcing option for Chinese buyers. U.S. corn remains competitively priced compared to Argentina-sourced grain, but still Argentina's bumper corn harvest could begin to challenge U.S. demand in the coming months. Thanks for watching. I'm Dawson Schmidt, and this has been Trader PhD.